And then coming to the 300 and 400 series, right, in 300 and 400 series, we are going to limit the number of questions we are going to revise, right? And coming to the 300 series, first standard is our 300, right? And that is planning and audit of financial statement. What is 300? Planning and audit of financial statement. And what is 315? Identifying and assessing the risk of material misstatements through understanding the entity and its environment. What? Identifying and assessing the risk of material misstatements through understanding the entity and its environment, right? And 320 is about materiality in planning and performance of audit. What? 320 is materiality in planning and performing an audit. 320 is materiality in planning and performing audit, right? 330 is the auditor's responses to the assessed risk. 330 is auditor's responses to the risk. That is 330 auditor's responses to the assessed risk. 402 is audit considerations in entities using service organization. Audit considerations in an entity using service organization. That is 402. Very unique standard and important standard too. 450 is evaluation of misstatements identified during the audit. 450 is evaluation of misstatement identified during the audit, and we are going to see the complete standard of 320 and 402, but 300 and 315 and 330 and 450 we are going to see only limited questions, right? And coming to the first standard, the 300, that is our planning and audit of financial statement. Is our planning and audit of financial statements. In this, it is very unique, very simple standard, but only no question is accepted on this standard, but we'll see only one question, that is our establishment of audit strategy and what the auditor will see for the overall development of audit strategy, right? The comment on the following, that the auditor shall establish an overall audit strategy that sets scope, timing, and direction of audit, and that guides the development of an audit plan, right? Establishment audit strategy and what are the audit strategy, what auditor will consider in planning that audit strategy. As far as 300, planning and audit of financial statements requires that auditor shall establish an overall audit strategy that sets the scope, timing, and direction of an audit, that guides the development of an audit plan. Right? He has to first establish an audit strategy and then scope, timing of direction of the audit that guides the audit plan. Audit strategy is first, then audit plan is next. And coming to the establishing the overall audit strategy, auditor shall consider the following things. There are about 5 things auditor shall consider. First, he has to identify the characteristics of the engagement that define its scope. First, he has to identify the scope of the engagement. Next, ascertain the reporting objectives of the engagement to plan the timing of audit and nature of the communications required. First, he has to identify the scope, and next he has to see the objective. What is the objective of this particular engagement? Identify the characteristics of the engagement that define its scope. Ascertain the reporting objective of the engagement to plan the timing of the audit and nature of the communications required. Right? He has to ascertain the objective so that he can plan his timing for that particular audit, and as well as he can how the communication will be done between the management and these persons. First, he has to identify the scope, next objective. And next, coming to the next point, that is consider the factors that are significant in directing the engagement team's effort. He has to consider significant factors, means he has to consider significant risk areas. He has to consider, and he can consider the results of preliminary engagement activities where applicable, that the knowledge gained on other engagement performed with the engagement partner for the entity is relevant. See, and he has to have preliminary engagement activities like before that terms of audit engagement, SA 210 is the preliminary audit engagement, some activities will be done. On that, you have to consider those activities, as well as if any other activity has been, other engagement has been involved, that the particular client, that particular engagement partner, that relevant knowledge of the particular engagement partner shall be taken, and ascertain the nature, timing, action of audit procedures to be performed necessary. A lot of things, what are the things he has to do? First, he has to see the scope, and then he has to see the objective, and next he has to see the significant time directing the engagement team efforts, and next the preliminary engagement activities, and next nature, timing, action of procedures necessary perform. This question is not accepted, but just only one question we are saying from SA 300. And coming to SA 315, that is identifying and assessing the risk of material misstatement through understanding the entity and its environment. SA 315, SA 330, and SA 450 are should be read in parallel, right? SA 315 identifying and assessing the risk of material misstatement through understanding the entity and its environment, and SA 330 is responses, means it is auditor's responses to the assessed risk. Means in 315 he will identify the risk of material misstatements, and in 330 he will auditor's responses to the assessed risk. Identify and assessing the risk of material misstatement through understanding and its environment, and 330 is auditor's responses to the assessed risk. Whereas 450 is evaluation of what? Is evaluation of misstatements identified during the audit, right? These 3 standards will be read in parallel, 315, 330, 450, right? Reference can also be given. Coming to the 315, in 315 is going to see the following questions, that is obtaining an understanding of entity and its environment. What are the factors that auditor shall, what are the broad matters to be considered while obtaining the knowledge of business for an audit engagement of a manufacturing concern? So not even manufacturing, but any concern. What are the broad matters to be considered while obtaining the knowledge of the business? Knowledge of the business means we have to see the 315, identify and assessing the entities, identify and assessing is common through understanding entities and its environment, right? Knowledge of business, we have to get, remember 315, what are the factors we'll see. And the next question is our Right, and it is our we will see the 315, that is assessment of risk of assessment of ROMA. We have two levels, that is the financial statement level as well as assumptions level. Assumptions level we have class of transactions, account balances, disclosures, right? And coming to the next question, we will see the point of indication that the direct auditor to judge that risk identified may be significant. See, in that particular risk assessment procedure, we will identify some risk, whether the particular risk is significant or not. What are the factors to be considered? These are the three questions we will see in this particular essay 315. And also one question we will see, that is risk assessment in CAS. And this question is very simple question, but a very abnormal question, but we'll see this question, but maybe expected this time. Risk assessment in CIS environment. What is that? Risk assessment in CIS environment. These are the questions we'll see now, essay 315. And coming to the first question. And coming to this, our first question, that is our in essay 315, identify and assessing risk of material misstatements for understanding understanding entity and its environment. The first question is obtaining an understanding of entity. How we are going to obtain essay 315, that identifying and assessing of risk of material misstatements through understanding entity and its environment. Auditor is required to obtain understanding of the following as part of its risk assessment procedure. Has to obtain the following. See, we'll see this knowledge of business. We'll categorize 6 parts are there. We'll categorize into 3 sets. One is related to the external factors. Next one is internal factors. Next one is past and future. Next one is accounting systems and internal controls. What are the 3 areas? External factors, internal factors, past, future, and accounting policies and internal controls. Coming to the external and internal first segment, we'll see in the external area, we'll see we have to understand the industry, regulatory, and other external factors, including applicable financial reporting framework. We have to understand that entity is operating which industry and which regulatory is regulating the particular entity, and also other external factors, including our applicable financial reporting framework, that is as per our Indian GAAP, that is our accounting standards and our Schedule 3, right? That is our external factors. External factors is industry, regulatory, and external factors, including our applicable financial reporting framework. Coming to the internal category, internal factors, we have to see the nature of the entities, and including the nature of the entity, we have to see, including its operations, ownership and governance structure, and types of investment the entity is making and plan to make, the way that entity is structured and how it is financed. See, the operation means what is the nature of the entity. First of all, we have the nature and what operation it is carrying on, and next we have to see the structure. What is the hierarchy of that management hierarchy structure? We have to see, that is organization and governance structure, and has the types of investment plan. What is it is planning in the future? What is the planning for type investment plan, and how it is going to make. And the way that entity is structured means how the structure is there, like how the capital, equity capital is there, preferential capital is there, and capital structure we have to see. These are the internal factors. And coming to the past and future. In past, we have the measurement and review of the entity's financial performance. In past, how is the entity's measurement? How is that measuring the performance? How the review about that entity's performance? That is, in past, we have to see the measurement and review of entity's financial performance. That is measurement and review of entity's financial performance. In past, we have to see. In future, we have to see the entity's objectives and strategies and those related with business risk that may result in significant risk of problem. See, in future means objectives. What is the entity objective? What is the entity strategy? That is future. What is the entity's objective, entity strategy, and those related business risk also will arise in future that may result in ROMM, that may result in a risk of material misstatement. These things in future we have to see. And coming to the next one is the accounting system. What is the accounting system? The entity selection, how the entity is selecting the accounting policy, and how it is applying the accounting policy, and include the reasons for changes there. Whether there is change in accounting policy, what are the reasons for that? Right? This is accounting policy. That is like the entity selection and application of accounting policies, including the reasons for the changes there too. And next is our internal controls. That is auditor shall obtain understanding of the internal controls relevant for an audit. Right? These are things we have to see in our first one, that is obtaining an understanding of the entities and its environment. Right? We have to see that the external, internal, past, future, accounting policy, internal controls. In external, we have to see the industry, regulatory, other external factors, including our applicable financial reporting framework. Whereas internal, we have to see what is the nature of the entity, and what is operations, and governance and ownership structure, and capital structure. That is, entity's structure, now it's financed, types of investment it is going to make. This is internal thing. And over the past, we have to see the measurement and review of entity's financial performance. That is, measurement and review of entity's financial performance. We have to see past. Future, we have to see objectives and strategies. What are the entity's objectives and strategies, and those related business risk also we have to see that results in our ROM, that is risk of material misstatement. We have to see it is past, future. And come to the accounting policy, that is how the entity is selecting the accounting policy and application of the particular entity policy. If there are changes, what are the reasons for that? That accounting policy we have to see. And also internal controls. The auditor shall also obtain understanding of the internal controls relevant to the audit. These are the type of first question we have to see, that is obtaining understanding of the entity and its environment, right? And the next question is our assessment of risk of material misstatements, right? 315 identifying and assessing the risk of material misstatement to understanding the entity and its environment requires auditor to identify and assess the risk of material misstatements whether due to fraud or error at the financial statements at the assertions level, right? This particularly requires the auditor to identify and assess the risk of identifying and assessing ROMM whether due to fraud or error, whether the particular ROM that is risk is due to fraud or error. He has to see at the financial statement as a whole. He has to see as well as the assessment level he has to see. That is as well as SST 315 auditor shall identify and assess the risk of material, assess the ROMM at the financial statements level as well as under assessment level. What is the assessment level? We have class of transactions, account balances, and disclosures to provide the basis for designing and performing their further audit procedure. Means based on this ROMM, identifying and assessing risk of ROMM, will strategize our further audit procedures, right? What is this thing? As a requires auditor to identify and assess the ROMM whether due to fraud or error at a financial statement or assessment level, right? This will help in our preparation of further audit procedures, right? And for this purpose, auditor shall for this assessing of risk of ROMM, for this assessing ROMM, what auditor has to do? This is a very important question. For assessing ROMM, what auditor has to do, right? For assessing ROMM, what auditor has to do is first he has to identify the risk throughout the process of obtaining understanding of the entity and its environment, including the relevant controls. See, we heard in the first question, right? In this, he has to identify the risk, identifying the risk throughout the process of obtaining understanding of entity and its environment, including the relevant controls. Those external, internal, past, future, accounting policies, and internal controls we have seen there. Whether not any identified risk are there or not. And next one, he has assess and evaluate the identified risk. What are the risk he has identified? He has to assess that risk and he has to evaluate the particular risk. And next, he has to relate the identified risk to what can go wrong at the assessment level. And he has to identify this risk, that is, we have identified this as financial as a whole, right? And he has to relate the particular identified risk to what can go wrong at the assessment level, at particular class of transactions. Account balances, disclosure in particular area, what it can go wrong, what this particular identified risk can go wrong there, and has to consider likelihood of misstatement. What is the chance of, what is the probability of the misstatement for that particular risk will happen. Okay. The auditor has to do the four things, very important, four things. What auditor has to do? First, he has to identify the risk or identify the risk throughout the process of obtaining understanding of the entity and its environment. Which we have seen the first question, right? Based on the first question, he has to identify the risk. Then after identifying the risk, what auditor has to do? Assess the risk and evaluate the risk, right? Assess the risk and evaluate the identified risk. Then he has to relate the particular identified risk to what it can go wrong at assessment level. Then he has to consider the likelihood of misstatement, right? And coming to the assessment of ROMM, we'll say once again what the auditor first he has to do, identify the risk which has the understanding entity and its operations, including the relevant controls. Then he has to assess and evaluate the identified risk. Then he has to relate the particular identified risk that what it can go wrong at the assessment level. And he has to consider the likelihood of misstatement. This is our next assessment question, assessment of ROMM. And particularly this consider question only 330, we have assessed this particular risk, right? And what will 330 will do? The 330 as for the auditor is responsible to the assessed risk. The auditor shall design and implement the overall responses or addresses the assessed risk of ROMM in the designing audit of procedures to perform the auditor, right? 315 have assessed the risk, but that auditor in 330 the auditor responses to the assessed risk. What are the particular assessed risk? He will give responses. Shall design and implement overall responses to the address the assessed risk. He will design an overall response to address the particular risk assessed in our 315. What we will do? Consider the reasons for the assessment given to the risk of ROMM at the assessment level for each class of transactions. He has to see the particular each class is transaction. He has to answer the reason for that. Why this particular is ROMM is given by the particular transaction, and then he has to consider obtain more persuasive audit evidence for auditor's assessment of risk. Right? More persuasive audit evidence he has to obtain for auditor's assessment of risk. First, what he has to do, consider the reasons for the assessment given to the risk ROMM at the assessment level, each class of transactions, account balance, disclosure, and obtain more persuasive audit evidence for auditor's assessment of risk. This is about assessment of ROMM as well as auditor's response to the assessed risk as per SA 315 and as well as SA 330. Right? Coming to the next question, that is our points of indication that direct the auditor to judge that risk identified may be significant. See, what are the auditor's risk identified as per 315, whether the particular risk is significant or not, how the auditor will identify. That is a question. That is as a 315, identifying assessing of risk of material misstatement through understanding entity and its environment, requires auditor to identify that assess the risk of material ROMM due to fraud or error at the financial statements level as well as assessments level. This is a simple objective of this particular standard. That is requires auditor to identify and assess the ROMM whether due to fraud or error at financial statements as a whole as well as the assertions level. Right? And coming as part of the risk assessment, the auditor shall determine whether any of the risk identified or in auditor's judgment significant risk see what are the risks has identified. In order judgment whether the particular risk is significant or not, he has to identify. In exceeding this judgment, the auditor shall exclude the effects of identified controls related to the risk. In exceeding judgment, he will see the particular things. That is, in exceeding judgment as to which risk or significant risk, the auditor shall consider at least the following. See, in exceeding the particular identified risk as significant risk, the auditor, or using his professional judgment, he has to at least consider the following things. At least consider the following things, right? And this question, that is, what are the points of indication the auditor has to judge that the risk are identified as very significant. At least he has to consider the following things. We have 6 points here. We'll divide this particular 6 points into 2 sets and 3 sets. 3 as one set and another 3 as another set. Right? And we have seen that significant risk by special audit consideration. That is our fraud. First set is of fraud, complexity of transactions, measurement, uncertainty. What is that? Fraud, complexity of transactions, measurement, uncertainty. And second set is our related parties, unusual transactions, changes in economical or regulatory environment. Second is our related parties, unusual transactions, changes in economic or regulatory environment, right? What is the first one? What is our first one? Is our fraud. First set is our fraud, complexity of transactions, measurement, uncertainty. Related parties. Second set is our studying the related parties, unusual transactions, changes in economic or regulatory environment, right? We have the 2 sets, that is a fraud, complexity of transactions, measurement, uncertainty. Second set is our related parties, unusual transactions, changes in economic or regulatory environment, right? Once again, we'll see fraud, complexity of transactions, measurement, uncertainty, related parties, unusual transactions, change in economic or regulatory environment. And right, coming to the first point, that is fraud. Whether the risk is a risk of fraud or not. Because of that, then also we can say that particular risk is significant risk. And from this complexity of transactions, complexity of if the transactions are complex, then we can say that is significant. Measurement, uncertainty. The degree of subjectivity in the measurement of financial information related to the risk, especially those measurements involving a wide range of measurement uncertainty. If that measurement of financial information has wide range of uncertainty, then that particular risk we have identified may be significant. Right? That is what they are saying. The degree of subjectivity in the measurement of financial information, subjectivity means it differs from one person to another person. The degree of subjectivity in measurement of financial information related to the risk, especially those measurement involving a wide range of measurement uncertainty, then it should be significant. What are the 3 points we have? Fraud, complexity of transactions, measurement, uncertainty. And going to the next category is related parties. What is that? Related parties. Whether the risk involves significant transaction with the particular related parties or not. Whether what are the risk we have identified or the particular risk is involving a transaction with the related parties, then we can say that is significant. And come to unusual transactions. Whether the risk involves significant transactions that are outside the normal course of business for the entity or that are otherwise appear to be unusual. Means unusual transaction, they're simply saying that other than the normal course of business transactions, any transactions occur that are unusual, then that particular risk can be significant. Right? And next one is changes in economical and regulatory environment. Whether the risk is related to the significant economic changes, accounting, or the developments like changes in regulatory environment, etc., and therefore requires specific attention. Right? These are the points we'll see for that whether the particular identified risk as 315 is significant or not. What are the points we'll see? Fraud, complexity of transaction, measurement, uncertainty, measurement financial information, especially the measurement uncertainty is significant. Related parties, what are the significant transactions with the related parties? Unusual transactions other than normal course of business. Changes in economical regulation, specific attention need to be given to the particular area. And these are 6 points. And coming to our next question is of risk assessment in CIS environment. That is risk assessment in computerized information system environment. We can say right shortcut of causes of risk at material misstatement in CIS environment. What are the causes of the particular risk at CIS environment? We'll see. Right. The question is 315. 3SA315 risk assessment in CIS environment. Right. The identifying and assessing risk of material misstatements through understanding entity and environment requires auditor to make an assessment of inherent and control risk for material financial statements assessments. In a CIS environment, the auditor should look into the below mentioned area for risk identification. The auditor will look into the below mentioned area for identifying the risks. Right. We are seeing the risk assessment in CIS environment. So we have a shortcut for this. That is PC POS. PC means our personal computer. POS means point of sale. In PC only point of sale. This discussion is related to the computer means we have the shortcut like this PC POS. Right? And what are the areas that the auditors have to see for the risk assessment, areas of risk identification? That is the first one is our program development and maintenance. That is our first P, program development and maintenance. And next one is our C, control over access to specialized utility program. Control over access to specialized utility program. And next one is our next P is our physical CI security or the security. And next O is our operations including processing of data, and S is our system software support. Right? This question looks like ISCA question, but maybe asked. Right? Just remember PC POS. Right? SA 315, identification and assessing the risk of material misstatement through understanding the detailed environment requires auditor to make an assessment of inherent and controlled risk for material financial statements. Assessments in a CAS environment, auditor should look into the following mentioned areas of PC, POS, program development and maintenance, control over access to specialized utility program. What? Program development and maintenance, control over what? Control over access to the specialized utility program. And next P is our physical CI security, and next O is operations including processing of data and system software update, right? System software support. This is a question of as per 315. And next we are jumping to 330, right? 330 we are going to see, we have already seen one question, that is how the auditor will respond to the risk identified as per 315. He'll consider the reasons, and next we'll obtain more persuasive audit evidence for auditor's assessment of risk, right? That is we have seen already. And next question we see that the factors warranting retest of controls, right? What are the factors that warrant retest of controls? This is the only question we'll see in particular. SA 330, that is auditor's response to the assessed risk. SA 330 we are going to see the what are the factors warranting retest of controls, that is our SA 330, the auditor's response to the assessed risk. In this particular question we will see it is only one question, factors warranting retest of controls, right? Then coming to this question, the factors warranting the retest of controls, right? What are the factors that warrant for retest of controls? As far as SA 330, that is auditor's response to the assessed risk. If auditor plans to use audit evidence from a previous audit about the operating effectiveness of specific controls, he shall establish a continuing relevance of that evidence by obtaining audit evidence about whether the significant changes in those controls have occurred subsequent to the previous audit. The auditor's decision on whether to rely on the audit evidence obtained in the previous audit of controls is matter of professional judgment, right? This question is like the auditor is, see for example, I am the same auditor for previous year as well as the current year. I am relying on the previous audit evidence we have obtained on the significant internal controls. I am relying on the previous audit evidence that the current year controls are also significant. Current controls are operating effectively. For that reason, I have to consider one thing, that whether there have been any significant changes or there or not. Right? Whether there have been significant changes in the current year, then I have to reconsider my audit evidence on the operating evidence of the control system. But also auditor has to be cautioned him about the factors that may warrant retest of controls. Means even if the audit evidence obtained previously that shows operating effectiveness of controls, even today there is no significant change, but these are some factors which warrant the auditor to retest the control, to reach the operating effectiveness of internal controls, right? What are that? We have 6 points here. Once again, we have 6 points here. We will divide this 6 points into 3 sets. That is, one set is our deficient set, and one set is our changes set, and next one is others miscellaneous. Right? The first one comes to deficiency set. We have deficient 3 points, and changes we have 2 points. In deficient, we have a deficient control environment, deficient monitoring of controls, deficient general IT controls. What? Deficient control environment, and deficient monitoring of controls, deficient general IT controls. And the next one is changes of personnel, changes of circumstances, changes of personnel. Personnel means the people, the employees. Changes of personnel and changes of circumstances. And next one is significant manual controls, significant manual elements, significant manual into the relevant controls, right? These are the things the auditor has to consider, the factors that they warrant the auditors for retest of control. The significant 3 categories, 6 points are there, 3 categories. Deficient control environment, deficient monitoring of control, deficient control environment, deficient monitoring of controls, deficient general IT controls, deficient what? Deficient, we are seeing control, deficient control environment, and deficient monitoring of controls, and deficient general IT controls. Okay. And changes in personnel, and changes in circumstances, and significant manual element involved in the relevant controls. See, we'll see the first point, that is a deficient control environment and deficient monitoring of controls, the same points. Deficient general IT controls, same as this, but personal changes that significantly affect the application of control. Personal changes means our staff, they are changing, that significantly affect the application of controls because of that particular training will be given. Because of that reason, that inefficiency will be there, right? That point, personal changes that significantly affect the application of control. And if it changes circumstances that indicate the need for changes of control, means that particular control which have been placed previously, the circumstances around it has changed, so we have to change the particular control again. That also warrants a retest of control. That is change of circumstances that indicate the need for changes in control. And our next one is our significant manual element to the relevant control, or is that significant manual element to the relevant control? What are the factors? Once again, we'll see deficient control of environment, deficient monitoring of control, deficient generality controls, changes in personal, changes in circumstances. Changes in personal means personal changes that significantly affect the application of controls, changing circumstances that indicate the need for changes in the controls, and significant manual element to the relevant controls, right? This is a very important question. Only one question is a very important question here is that factors warranting retest of controls: a deficient internal control system, deficient monitoring of controls, and deficient general IT controls. Personal changes that significantly affect the application of control, changes that indicate the need for changes in the control, significant manual element to the relevant control, right? And coming to our last standard in our 400 series, that last lab 450, that is our evaluation of misstatements identified during the audit. What is it? Evaluation of misstatements identified during the audit. Evaluation of misstatement identified during the audit. We are going to receive only one question, the source of misstatement. As far as I say, 450, evaluation of misstatement identified during the audit. Generally, misstatement means what it is and what it should be. The difference between what it is and what it should be, it is called misstatement. As per SA 5450, the evaluation of misstatement identified during the audit defines the term misstatement as a difference between the amounts, classification, presentation, disclosure. What? Amounts, classification, presentation, disclosure. Amounts, classification, presentation, disclosure of reported financial statements item and to the top amount, classification, presentation, disclosure that is required for the item to be in accordance with applicable financial reporting framework. That is the misstatement. What they are saying, misstatement as a difference between amount, classification, presentation, disclosure of reported financial statements to amount, classification, presentation, disclosure of the item required as per our applicable financial reporting framework. It is called as misstatement. Right? Accordingly, misstatement may cause due to the following. What are the source of misstatement? What are the causes of misstatement? There we have shortcut, that is ODI IA. What is the shortcut? ODI IA. ODI IA. That is one day international system, one day international, our internal audit. ODI IA. And coming to the first one, O, an omission of amount or disclosure. Omission of amount, omission of an amount or disclosure. It is also a misstatement. And next one is D, that is difference in the judgment. Difference in the judgment of what? Different in judgment of management versus different judgment of auditor. That is our judgments of management concept for accounting estimates that auditor considers unreasonable. Right? Accounting estimate that management judgment is different as auditor judgment is different. That in that case also misstatement, that is a source of misstatement. That is judgments of management concerning the accounting estimates that the auditor considers unreasonable. That is our D. And next one is our I is inaccuracy. Inaccuracy of what? Inaccuracy in gathering or processing data from which the financial statements are prepared. Inaccuracy, the data processing or gathering is inaccurate for preparation of the financial statement. Then also there is a misstatement. And next one, next I is our internal audit, right? Next I is our incorrect accounting estimate. Incorrect accounting methods arising from overlooking or clear misinterpretation of facts. Incorrect accounting estimate by overlooking the just some estimate they are taking, or clear misinterpretation of fact. That is very clear as a mistake happened from report that we clearly misinterpreted the fact and they are giving incorrect accounting estimate. And next I is our accounting policy. Selection and application of accounting policies that the auditor considers inappropriate. Right? These are the 5 sources of misstatements. What are the source of misstatements? We source the misstatement what it should be or what it is. That is the difference is misstatement. They are saying difference between the amount, classification, presentation, disclosure. Amount, classification, presentation, disclosure as per the required financial information item, and to the top the amount, classification, disclosure, presentation of the required applicable financial reporting framework. That is misstatement. And what are the sources? ODI IA. O, omission of an amount or disclosure. Omission of an amount or disclosure. D, difference between the management judgment of accounting estimate as well as auditors. That is the judgment of management concerning accounting estimates that the auditor considers unreasonable. And I is or inaccuracy. Inaccuracy in what? Inaccuracy in gathering and processing of data which is used for preparation of financial statements. This I, ODI is next. Next I is inaccurate. Inaccurate what? Inaccurate accounting estimates arising of overlooking or clear misinterpretation of what? There is clear misinterpretation of facts or overlooking. They are giving incorrect accounting estimates. Next, A is our accounting policies. Selection and application of accounting policies are considered inappropriate. Right? These are the source of misstatements. Right? You can come to the standard, that is our materiality SA 320. The materiality in planning and performing audit. What is that standard? Materiality in planning and performing audit. Right? In this, we'll see the concept of materiality and the concept of performance materiality and what are the auditor's duties, and we'll see the 2 important questions when the revision of materiality is possible and the use of benchmark in determining the materiality. Right? These are the questions we'll see in the particular chapter. What are the concept of materiality? We'll see performance materiality, auditor's duties, and use of benchmark in determining the materiality and revision of materiality when it is possible. Right? And coming to if you use the materiality, we can use in our 3 standards. That is, I say 300 in planning of an audit plan. We use the materiality, and as per in our SA 320 in planning and performing an audit, we'll use the materiality. And as per SA 550, that is evaluating of material misstatements, we will use the materiality concept. Right? These are the 3 references that we can give when the question is asked by materiality. That is 320 planning and performing, 300 planning, 450 evaluation of material misstatements. Right? And come to the concept of materiality. What is materiality? Materiality is a subject of professional judgment and discussion presented in the financial reporting framework, provides a reference to the auditor in determining materiality. Right? See, what the materiality is a professional judgment. From one auditor, it is a subjective concept. It is professional judgment, and discussion presented in the financial reporting framework provides a reference to the auditor to determine the materiality. Means some of the financial reporting framework, some discussions are there. Right? Some discussions are there. Right? Based on the discussions, the auditor can determine the materiality level. And if the financial reporting framework does not include a discussion, following can be referred. If the FRF, that is financial reporting framework, does not have any discussions on this particular thing, then the auditor can refer the following. That is, misstatements including the omissions expected to influence the economic decisions of users. If any misstatement that includes the economic decisions of users, based on that, also auditor can determine the materiality. And size and nature of the misstatement and the surrounding circumstances, the common financial information needs of the users of the group. Based on these three things, the auditor will determine the materiality. What is the materiality? First, it is a professional judgment, and it will be determined based on the discussion in the FRF. No discussion is there. You will see the misstatement including omission expected to influence economic decisions of the users, and size and nature of the misstatement and uncorrect on its surrounding circumstances and common financial information needs of the users of the group. Right? The judgment of materiality provides the basis for, means we have determined the materiality. On the basis of materiality determination, it helps the auditor in doing determination of nature, determining extent of risk assessment procedures, and identifying and assessing the risk of material misstatement, nature, timing, extent of further audit procedures. Like this materiality, after determining materiality, it will help the auditor in determination of risk assessment procedures and determination of ROMM, that is risk of material misstatement, as well as determination of nature, timing, extent of further audit procedures. Right? This is about the materiality concept. And come to the performance materiality. Performance materiality here, the amount set by the auditor at a less than materiality of financial statements as a whole to reduce an appropriately low level of probability that the aggregate of the uncorrected or undetected misstatements exceed the materiality for the financial statements as a whole. See, this is very important, like performance materiality, right? It is an amount set by the auditor at less than the materiality for a financial statement. For example, auditor has determined some materiality level. For example, assume that is 100, and this performance materiality is below that 100, less than the materiality of financial statements as a whole, to reduce the appropriately low level of probability that the aggregate of uncorrected or undetected misstatements exceed materiality. For example, see, if the materiality level we have put is 100, because of that reason we are checking that all the transactions above 100, right? We are not checking the transactions below 100. So we have to keep the material, we have to give the performance in such a way that the below 100 undetected or uncorrected misstatement shall not exceed the 100 limit, right? That is what they are saying. Performance materiality. Once again, we'll see the amount set by the auditor at less than materiality for financial statements as a whole to reduce an appropriately low level the probability that the aggregate of uncorrected, undetected misstatements exceed the materiality for financial statements as a whole. Once again, we'll see the amount set by auditor at less than the materiality level for the financial statements as a whole. Auditor has set a materiality for financial statements as a whole. It has to set that below the materiality level to reduce what? To reduce appropriately low level the probability appropriately low level the probability of what? The probability that the aggregate of what? Aggregate of two things, that is uncorrected as well as undetected misstatements exceeds what the materiality set for the financial statements as a whole. This is performance materiality. And coming to that auditor's duties, what the auditor's duties in this respect of SA 320, the main auditor duties are materiality in planning and performance audit. The main auditor duties are upon establishing the overall audit strategy, the auditor shall determine the materiality for the financial statements as a whole. Upon establishing overall audit strategy, the first of all audit strategy has to be established. Upon that, the auditor shall determine the materiality of the financial statements as a whole. As a whole, he has to do. Then materiality can be determined on the basis of materiality as a financial statements as a whole, as well as the specific transactions. Also, we can put the materiality level. That is, upon establishing the overall audit strategy, the auditor shall determine the materiality for the financial statements as a whole, or determine the materiality level for specific transactions for which misstatements of lower amount be expected to influence the economic decisions of users. Means he can determine materiality level for the particular class of transactions, or specific transactions for which the misstatements of lower amount be expected to influence the economic decisions of users. Right? Two materiality can be used as a financial statements as a whole, or as for account balances, transactions also can be materiality can be put if he thinks that it will affect the economic decisions of users, right? And come to the next one is determine the performance materiality for the purpose of assessing the ROMM and determine the NTE of the further audit process. Right? He has also determine the PM, that is performance materiality, to determine the ROMM. We have already seen that, and as well as an NTE of further audit process. Right? This is all about general content. And coming to two important questions we have, that is revision of materiality and use of benchmark in determining the materiality. Right? First of all, see the benchmark. What is benchmark? A percentage is often applied to choose and benchmark as a starting point in determining the materiality for the financial statements as a whole. See, benchmark means a percentage is often applied to choose and benchmark starting point in determining materiality of financial statements as a whole. For example, that benchmark we have taken is the sales revenue. See, for example, you see that materiality level is 10%. For example, sales is 1 lakh, which is the 10% is 10,000. So the materiality level is 10,000. That's what they are saying. A percentage is often applied to a chosen benchmark. A percentage is often applied to chosen benchmark as a starting point determining materiality for the financial statement as a whole. This is called benchmark. And what are the factors affecting the identification of appropriate benchmark? There are some various. We can take sales revenue. You can take purchases, we can take cost of goods sold, we can take turnover, whatever we can take. That is benchmark we can take. But based on that, what are the factors affecting the determination of appropriate benchmark? Means getting the appropriate benchmark, which is a correct apt benchmark. We have to see the following factors. We have a shortcut for that. Venus, right? Venus. VENUS, Venus. The shortcut is Venus for the factors affecting the determination of appropriate benchmark, right? The Venus, that the factors affecting the identification of appropriate benchmark. Venus, we have V for volatility, V is for volatility, and E is for elements of financial statements, and N is for the nature of the entity, N is for the nature of entity, and U is for the users, and S is for the structure, right? V is for volatility, E is for elements of financial statements, and N is for what? N is for nature of entity, and U is for users, and S is for structure. Coming to the Venus, that is V volatility, the relative volatility of the benchmark. We have to see the relative volatility of the benchmark, right? The relative volatility of the benchmark can be seen. And going to the next one, the elements of financial statement. The elements of financial statement, for example, the assets, liabilities, equities, revenue, expenses, the elements of financial statements. And next one is our N. N is the nature of entity, where the entity is at its life cycle and the industry, economic environment in which the entity operates. Means the nature of entity, where the entity is at its life cycle and the industry, economic environment in which it operates. Means what is the nature of that entity, and in that particular life cycle, means we know that the growth stage, decline stage, saturation point, that life cycle, at what point that entity is there, and as well as the industry and economic environment, what is the industry and economic environment in that particular entity is operates. These points also will affect that factor determine the appropriate benchmark. What is Venus? That is nature of entity, where the entity is in its life cycle, as well as the industry and economic environment in which operates. That is VEN. And coming to US, that is users, right? And items on which the attention of the users of the particular entity's financial statements tend to be focused, right? Whether there are items on which the attention of the users of the particular entity's financial statements tend to be focused. For example, the user's main focus will be on profits, revenue, data sets, right? On this basis also that affects the determining the appropriate benchmark. That is items on which the attention of the user or particular financial event tend to be focused. And next one is yes, the entity's ownership structure and the way it is financed. Yes is for structure. The entity is the entity's ownership structure and the way it is financed. For example, if an entity is financed solely by debt rather than equity, users may put more emphasis on assets and claims on them than on equity entity's earnings, right? Based on the entity structure and the way it is financed, also it depends on the factors affecting the appropriate benchmark. What are the factors affecting the appropriate benchmark? We'll see the elements of financial statement, the elements of what? The elements of Venus. V is for the relative volatility of the benchmark, and V is the elements of financial statements, and N is for the nature of entity and the entity in its life cycle and the industry environment in which operates, and U is for the users attention, right? Users focus the items and whether the attention of the users or particular item, a particular entity financial events is to be focused, tends to be focused. That is S is for structure. What is structure? Structure of entity and the way it is financed. These are the factors affecting the identification of appropriate benchmark. And coming to the next one is the revision of materiality. When the revision of materiality is possible, these two questions are very important questions. The revision of materiality. In the event of benchmarking, aware of information that would have caused auditor to have determined a different amount initially, auditor shall revise the materiality for the financial statement as a whole, and if required for a particular class of transactions, account balances, and disclosures. Right? During the process, some additional information or change information or new information has come to the auditor, and that because of that additional information or change information or new information, the auditor is thinking the auditor at the point of determining materiality would have caused the auditor to determine a different amount of initially. Then the auditor can revise materiality level as financial matter as a whole, as well as he can revise materiality for the specific account balances, class of transaction disclosures also. And this is the one point. And next point is the auditor concludes the lower materiality than that initially determined is appropriate. The auditor shall determine whether it is necessary to revise performance materiality and whether the nature, timing, extent of further audit process to remain appropriate. See, and if the second case is if the auditor concludes the lower materiality than that initially determined is appropriate. If the auditor thinks that, for example, 100 is there, and the auditor thinks that below that 100 the materiality level should be there, means 90. Then the auditor can think that to decide whether the auditor shall determine whether it is necessary to revise performance materiality. That performance materiality below that materiality level is we have fixed rate. Whether that auditor can do or not, he has to check, and whether that nature, timing, extent of other approaches are remain appropriate also we have to check. Right? What are the cases? Once again we'll see. That is, auditor shall revise materiality for a financial business as a whole, and if applicable, the materiality level of particular class of transaction or such disclosures. In the event of becoming aware of information during the audit that would have caused the auditor to have determined different amounts initially, if the auditor concludes lower level of materiality of the same, then he should consider the fact that whether it is necessary to revise performance materiality and whether the nature, timing, extent of other approaches remains appropriate. These are two important, very, very important questions as in essay 320. For the two questions, factors affecting benchmark and revision of materiality. Right? This is all about essay 320. And coming to our next standard, that is essay 402, very important standard, very unique standard in the entire standards of auditing. Essay 402, the number also unique, essay 402. Once again, essay 402, audit considerations relating to entity using a service organization. What? Audit considerations relating to an entity using service organizations means an entity using service organization as an organization. In that particular, relating to what auditor considerations in this particular situation, it is specific standard. Audit considerations relating to an entity using the service organization. The question is expected from this standard this time. Audit considerations relating to an entity using a service organization. Once again, audit considerations relating to entity using service organizations. We'll see the basic definition. What is the user auditor, what is service auditor, what is the service organization, and what is the user entity, what is the type 1 report, what is type 2 report. See, for example, coming to the user auditor. User auditor means an auditor who audits and reports the financial statements of the user entity. Who audits and reports the financial statements of the user entity, right? And user entity means an entity that uses service organizations and whose financial statements are being audited. User entity means that entity which is a service organization and whose financial statements are being audited. And service organization means the service organization which provides the services to the user entity, right? And service auditor means the service auditor which provides the information that is audit report about internal controls of the service organization, right? That is service auditor. And type 1 report is report on the description and design of internal controls at the service organization for a specified date. Type 2 report on the description, design and operating effectiveness of the controls of the service organization for a specified period. Great. Type 1 report, type 2 report. Type 2 report is more reliable. By seeing the definition, you can say type 2 report is more reliable than type 1 report. Type 1 report, once again, type 1 report consists of only the description and design of internal controls at a service organization for a specified date, only one date, as from some date, particular date, as on the date they will define. Whereas type 2 report contains the report of description, design and operating effectiveness of the controls at a service organization for a specified period. Right? Type 1 report only description and design at a specified date. Type 2 report is design, description and operating effectiveness of the controls of a service organization for a specified period. Right? This can be textured as MCQ. Right? This is all about the introduction. Coming to the auditor's objective. What is the auditor's objective? Objective to obtain an understanding of the nature and significance of services provided by the service organization and the effect on the user's entity internal control relevant to the audit, sufficient to identify the assessing the risk of material misstatements. Right? What he has to do, he has to obtain understanding of nature and significance of services provided by the service organization and their effect on the user's entity internal control. See, first he has to identify the service, the nature of service, the significance of service, all provided by the service organization, and it affects on user's internal control relevant to the audit, sufficient to identify the assessing the risk of material misstatement. First, what we have to do? First, we have to understand the nature and significance of the services provided by the service organization. Then, effect on that user's internal control. Then relevant to the audit, then sufficient to identify the ROMM, sufficient to identify assessing the ROMM. This is auditor has to do to design and perform audit process responsive to those risks. First, we have to do this in order to design the audit program for this response for that particular situation. What the auditor has to do, obtain understanding of the nature and significance of the service provided by the service organization and the effect on user internal control related to the audit, and sufficient to the identify and assessing the risk of ROMM, right? And coming to the next, that is our one important question we are going to see, that is obtaining understanding of services provided by the service organizations. The user auditor shall obtain an understanding of how user entity uses the service of service organization in the user entity operation, including, see, for obtaining understanding, we have to see the following things we have shortcut for it. It's Samir, SAMIR without AA, that is A is cancelled, Samir. The SC is referred to the significance and M is referred to the materiality and I is referred to the interaction and R is referred to the relationship, right? Samir without a A, and S is the significance, M is the materiality, I is the interaction, and R is the relationship. The user auditor shall obtain understanding of how user entity uses the service of service organization in the user entity operations, including, yes, the nature of services provided by service organization and the significance of services to the user entity. See, the nature of services provided by service organization and significance of services to the user entity. That is one point. First, the significance of service to the user entity, the nature of service provided by user entity, the nature of service provided by the service organization to the user entity, and significance of the service provided by the service organization to the user entity. Significance, yes, is finished. And come to the M, the nature and materiality of the transactions processed or financial reporting process affected with service organizations, right? We have to see the nature and materiality. What is service organization doing? What is outsourced service? The nature and its materiality. The nature and materiality of what? The nature and materiality of the transactions, processes, or financial reporting process affected by service organization. What the service organization has done, that is the nature and materiality of that particular transaction, processed or financial reporting processed, affected by what service organization. This is another M completed. And coming to the I, degree of interaction between the activities of service organization and those of the user entity. What is the degree of interaction? How they are interacting with each other, right? That is also main case for understanding the service organization. And next one is R, that is nature of relationship between the user entity and the service organization. The nature of relationship, the degree of interaction, the nature of relationship. See, we have SUMMI, that is nature of services provided service organization and significance of services. Another nature of materiality of the transactions processed or reporting financial reporting process affected by the service organization. That is our M. And going to the I is the degree of interaction, and A is the nature of relationship. Right? This is all about the obtaining understanding of services provided by the service organization. Right? And coming to the next one, that is our audit considerations. See, what if the auditor is unable to obtain sufficient understanding from the user entity, right? The question is that the user auditor shall evaluate the design and implementation of relevant controls of user entity that relate to the services provided by the service organization. First, user auditor shall evaluate the design and implementation of relevant controls of the user entity. What is the user entity is doing with the particular services provided by that service organization? What is the design and implementation of the particular controls you will see. And next, you will see user auditor shall determine whether there is sufficient understanding of the nature and significance of services provided by the user service organization and their effect on the user entity control relevant to the audit has been obtained. That is, we have seen that the objective, right? That thing has copy paste here. The user auditor shall determine whether the sufficient understanding of the nature and significance of the services provided by the service organization and their effect on the user entity internal control relevant to the audit has been obtained or not. See, he has to see that particular thing. What is that particular thing? That is sufficient understanding of the nature and significance of services provided by the water SO and their effect on user internal controls has been obtained or not. That thing auditor has to see. After obtaining such information, what auditor will do? To provide for assessment of risk of method misstatement, that will be useful. And the next one, what is the case? If the user auditor is unable to obtain a sufficient understanding from the user entity, what he has to do? If the user auditor is unable to obtain a sufficient understanding from the user entity, user auditor shall obtain the understanding from the following procedure. Means if the user auditor is unable to obtain that particular effect, then what auditor has to do is he has to do the 4 things: obtaining type 1 report and type 2 report if available, and contacting the service organization through the user entity, visiting the service organization, using another auditor to perform procedures that will provide the necessary information about the relevant controls at SO. Right? These are the 4 things auditor has to obtain: type 1 type report, or contact the service organization through the user entity, or visit the service organization using another auditor to perform the procedures that will provide the necessary information about the relevant controls at the S4. What are the 4 things? Once again, we'll see: obtain type 1 report or type 2 report. Go to the service organization and ask them, service auditor, obtain type 1 report and type 2 report. And next one, he has to contact SO through user entity. Or next, he can directly visit the SO. Next, he can use another auditor work to perform procedures that will provide the necessary information about the relevant controls at SO. These are the 4 things. And coming to one more important point is there, right? Subservice organization one point is there. This is very important, expected one. Subservice organization means, for example, A Limited is there, and A Limited is getting services from service organization, and also it is getting services that service organization is being employed by they have used the work of another organization for this particular entity. That is subservice organization, you can say. In that case, what auditor has to do? If service organization uses the subservice organization, the service auditor reports may either include or exclude the subservice organization relevant controls, objectives, and related internal controls in service organization's description of its systems in the scope of service auditor's engagement. These 2 methods of reporting are known as inclusive method or carve-out method, respectively. See, we have seen type 1 report, type 2 report, rate of service auditor. In the type 1 report, you have seen description, design of internal controls at service organization for a specified period. And type 2 report, description and design and operating effectiveness of controls at service organization for a specified period. right? Specified date, specified period. In that, if that is service, if the SO is using service organization, that service audit report, type 1 report or type 2 report may include or may not include what? The description, design and controls of sub-service organization, right? If it includes, it is called inclusive method. If it excludes, it is called correlate method. That is once again we'll see, once again we'll read. If the service organization uses a sub-service organization, the service auditor reports may either include or exclude the sub-service organization, relevant control of objectives and related controls in the service organization, description and its systems in the scope of service auditor's engagement. These two methods of reporting are known as inclusive method or correlate method respectively. In that case, if type 1 report or type 2 report excludes the controls of sub-service organization and the services provided to the sub-service organization are relevant to the audit of users and entity financial statements, the user auditor is required to apply the requirements of the CSA in respect to the sub-service organization. See, for example, the sub-service organization work is relevant to that our user auditor for determining the internal controls of this particular user entity. Then what the user auditor has to do, he has to check the requirements of this particular SA. That is what he has to again check the same things, right? That is again he has to check the same thing, that is Samir. Understanding entity service organization, product service, sub-service organization, right? Then we have to replace nature of services, product the sub-service organization and significance of services to the user entity, nature of material of the transactions processed, financial statement processed by the sub-service organization, degree of interaction between the activities of sub-service organization and the user entity, nature of relationship between the user entity and the sub-service organization. This point, that is, and again he has to see the requirements of this particular thing. That is, if type 1 report and type 2 report excludes the controls of the sub-service organization and the services provided to the sub-service organization are relevant to the auditor of the user entity, then the relevant financial statements, the user auditor is required to apply requirements of this SA in respect of this sub-service organization. The nature and extent of work to be performed by the user auditor regarding the services provided to the sub-service organization depend upon the nature and significance of those services to the user entity and relevance of those services to the auditor. Right? This is the case. He has to perform again the requirement. He has to see again the requirements of this particular SA. 402, that is audit considerations relating to the entity using of service organization. Very important standard. I think this sub-service organization question will come, or that what the auditor will do if he is unable to obtain sufficient understanding of the entity, that is obtaining type 1 type report, contacting service organization through user entity, or visiting the service organization using another audit work to get that particular relevant control sets SO, or we can get the Samir wala question. Right? These are the 3 questions that can be accepted particularly standard. Only 3 questions are there. 402, audit considerations relating to the entity using service organization. Right?